All right, it's October 21st. The market is right at a major decision point. We're pushing all-time highs, but there are some serious macro risks on the table. Let's get into the data-driven setup for the week.
So here's the fundamental problem we're facing. You've got the S&P 500 knocking on the door of new highs, which feels bullish, right? But at the same time, risk is clearly elevated. We're now 4 weeks into a government shutdown, which is throwing a ton of uncertainty into the mix. And on top of that, we're getting some really mixed signals from different asset classes.
This all boils down to one critical question. Is this a real breakout we can trade, or is it a classic bull trap designed to lure everyone in before the floor drops out? The data actually points in both directions, which is interesting. So let's dig in and see what the numbers are telling us.
Okay, first up, the news. These are the main headlines that are going to move the tape this week. Pay attention to these.
You can really feel the tension in these points. The shutdown, that's just a constant weight on the market's shoulders. Then you've got the S&P bumping its head against that 6750 resistance level. But here's the weird part. Stocks are strong, but gold is rallying too. That's a classic divergence, a risk-off signal screaming that something's not quite right. The only things on the calendar that are guaranteed to cause a stir are earnings from Netflix and Tesla. Expect some fireworks there.
All right, let's zoom in on the macro picture. These are the specific events that are going to either pour fuel on this fire or put it out completely.
So, the timeline for the next couple of weeks is pretty straightforward. The shutdown is just ongoing. It's the background noise we have to trade around. But this week, it is all about earnings. The options market is already pricing in a plus or minus 8% move for Netflix and a 9% move for Tesla. Now, those are big numbers. And the wild card in all of this? A surprise Senate vote on a funding deal. That could flip the script in a matter of minutes.
And this chart really drives the point home. A 9% swing in a giant like Tesla doesn't just move the stock. It can drag the entire sector with it. You see this high implied volatility? It's not there by accident. The market is telling you it has no idea what their forward guidance is going to look like. So these reports, they aren't just about hitting a number. They're about setting the entire story for the next 3 months.
Okay, let's look under the hood, because, the index price itself is really only half the picture.
Now this is a major red flag for me. You've got the S&P 500 making a run for the highs, but look at the internals. Fewer and fewer stocks in the NASDAQ are actually participating. The number of stocks trading above their 200-day average is dropping off. This is a classic sign of a weak market, where just a few mega-cap names are doing all the heavy lifting. You absolutely have to pay attention to this divergence.
And speaking of risk, let's look at crypto for a second. The current Bitcoin bull run is now over 1,050 days long. Why does that matter? Well, the historical average for these cycles, from bottom to top, is about 1,065 days. We are right in that window where, historically, a major top could be put in. This is a really important barometer for overall risk appetite in the market.
All right, forget the noise. These are the only numbers that matter right now. For the S&P, think of 6,700 as the floor. A ton of put support is sitting there. 6,750 is the ceiling we have to break. That's a huge gamma switch level, meaning if we push through it, the move could accelerate fast. And if we clear that, the next big target is the 7,000 call wall. For Tesla, all eyes are on that 420 to 430 put wall ahead of earnings.
This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice.
Okay, so with all that data, let's game out the 3 most likely scenarios from here.
So my base case is that we just chop around between 6,700 and 6,750. The market's basically just treading water, waiting for news. The bull case is pretty straightforward. We get a shutdown deal, tech earnings come in strong, and we get a clean breakout above 6,750. And the bear case? Well, that's what happens if the politicians fail and earnings guidance is weak. 6,700 support will break, and that ugly market breath will finally matter.
All right, let's start with the bull thesis. What's the path to higher prices from here?
For the bulls to take control, it's really about 2 things. Get a deal done on the shutdown and get solid earnings out of big tech. If those 2 things happen, the biggest risks are off the table. The technical signal we need to see is a sustained break above 6,750. If we get rejected hard at that level, or, worse, break down below 6,700, then this bull thesis is dead in the water.
Okay, now for the other side of the coin, the bear thesis. This is what happens if all those risks we talked about actually hit. So the bear case gets triggered if this shutdown just keeps dragging on and starts to really erode confidence. Then, if you see Bitcoin roll over, confirming that cycle top, that's a big risk-off signal. The 1-2 punch would be a big earnings miss from a name like Tesla, combined with those weak internals we saw earlier. That's the recipe for a breakdown. This whole idea is wrong, of course, if the market just shrugs it all off and reclaims 6750.
All right, so how could you potentially trade these scenarios? Here are a few ways to structure a trade with defined risk. First up, a bullish play on Tesla going into earnings. The whole idea here is that the big put wall between 420 and 430 acts as a floor. You could use a bull put spread to sell that high pre-earnings IV. It's a defined risk trade, and you know you're wrong if the stock closes below 420.
Next, if you think the whole market is ready to break out, you could look at a debit call spread on SPY. The thesis is simple. We break 6750 and make a run for that 7,000 call wall. This is a great way to play for that upside momentum while capping your risk at the premium you pay for the spread. If 6700 support fails, the thesis is busted.
And last, a defensive play. If you're more worried about the shutdown risk, you might consider a put debit spread on SPY. This is all about buying some downside insurance for your portfolio at a cheaper cost than just buying a straight put. Now let's be clear, this isn't a bet on the market crashing. It's a risk management move. Your max risk is the debit you pay, and you should size it to hedge, not to speculate.
So there you have it. The levels are clear, the catalysts are on the calendar, the risks are staring us in the face. The only question left is which data point are you going to be watching to make your move this week? Is it the politics, the earnings, or the price action? You need to have a plan.
Not trading advice, just a market update to keep you informed. Markets carry a risk. Trade your plan, manage downside, and verify all data.